Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, sir and my friend. Today, we are going to present our presentation by Group 5. It's about other debt and obligation. First, let me introduce our group member. First is me as moderator, Farrel Nakega. The second is Jeremia Aprilianto Maldin. The third is Muhammad Farhan. And the fourth is Zulius Ari Darma. So the first slide will be picked by Zulius.
Okay, I would like to explain about other debt and obligation, definition and classification. Company debt is an obligation to other parties arising from the main activities of the company. And then the classification of liabilities is intended for the purpose of measuring the level of company liquidity, namely the level of the company's ability to carry out business activities without funding difficulties. The next is liabilities can be classified into two groups. The first is short-term liabilities, namely debts that must be repaid within a short period of time, no later than 1 year after the balance sheet date, or must be repaid within 1 year of the normal operating cycle of the company concerned. What is meant by the normal operating cycle is the time required for cash to be converted into inventory, good inventory to be converted into accounts receivable, and finally trade receivable to be converted into cashback. And the second is long-term liabilities. Is an obligation to certain parties that must be repaid within more than one accounting period or 1 year, calculated from the balance sheet date as of December 31. Companies to obtain economic resources that will be used to finance activities, especially those that are long-term. The company can issue a certificate, which means making a debt agreement, stating that the maker is willing to pay interest on the loan periodically during the term. Short-term debt and its type. The definition. The ESB, as part of the conceptual framework, defines debt liabilities as present obligation of the company arising from past event, the settlement of which is expected to result in cash outflows from the company's resources, embodying economic benefits. So the liability has three important characteristics. Its obligation now arises from past event, payment cost, and outflow of resources. So, and the next is short-term debt. Current liabilities are reported when one of following two conditions is met. The first is completion is carried in one normal operating cycle, and the second one is completed 12 months or 1 year after reporting date. And the next is types of current liabilities. The first is accounts payable. Accounts payable or trade accounts payable is the balance that must be paid to other for goods, equipment, or service purchased with later payments or open account. Next is notes payable. Not payable is a written promise to pay a certain amount of money in the future according to a specified date. Notes payable may arise from purchase, financing, or other transaction. The next is current maturities of long-term debt. The highest group, or BAL, reports the portion of bonds, mortgage notes, and other long-term debt maturing within the next fiscal year as short-term liabilities. The company theorizes this amount as the current portion of long-term debt, or current maturities of long-term debt. Companies such as Delhaize do not include long-term debt currently maturing as short-term liability if the debt settled by assets accumulated for this purpose that have not been properly displayed as current assets, refinanced or set from the money reserve through new debt, and then converted into common stock. The next topic will be explained by Jerry.
The next type of current liabilities is refinance short-term debt. Short-term debt obligations that are scheduled to mature within 1 year after the date of the company's statement of financial position or in the normal operating cycle. Several short-term obligations are expected to be refinanced in the long term. This short-term obligation will not require the use of working capital during the coming year or operating cycle. Next, refinancing criteria. To address this classification problem, the IASB has developed criteria to determine the circumstance under which short-term liabilities can be properly excluded from short-term liabilities. In particular, companies can exclude short-term liabilities from current liabilities if both of the following conditions are met. The first, the company must intend to refinance the obligation on a long term. Second, the company must have the unconditional right to defer settlement of the liability for at least 12 months after the reporting date. To illustrate, Haddad Company provides the following information regarding notes payable. First, issued a note payable of 3 million euro on November 30, 2011, due on February 28, 2012. Haddad's reporting date is December 31, 2011. Haddad intends to extend the maturity date of the loan or to refinance the loan until June 30, 2013. Third, the company's financial statement as of December 31, 2011 are permitted to be published on March 15, 2012. The fourth, documents required to refinance the loan will be completed on January 15, 2012. Haddad does not have the unconditional right to defer settlement of the obligation as of December 31, 2011. For the illustration of the Haddad you can see it on this graphic. In this case, Haddad had to classify the notes payable as current liabilities because the refinancing was not complete by December 31, 2011, the financial reporting date. If the refinancing is complete before December 31, 2011, Haddad can classify the note liability as non-current. The reason refinancing liabilities after the statement of financial position date does not affect the liquidity or solvency at the statement of financial position date. The reporting party must reflect the contractual agreement in force at the date. What happens if Haddad has the intention and discretion in the loan agreement to refinance or roll out the 3 million euro note payable by 30 June 2013? In this case, Haddad must classify the notes payable as non-current because the company has the ability to defer payment until June 30, 2013. The next types of current liabilities as dividend payable. A cash dividend payable is the amount a company must pay to its shareholder as a result of the authorization of the board of directors, or in other cases, shareholders vote. At the announcement date, the company assumes an obligation to place shareholder in creditor position in the amount of dividend declared. Because the company always pays cash dividend within 1 year of announcement, or usually within 3 months, the company classifies the dividend declared as short-term liabilities. On the other hand, the company doesn't recognize accumulated dividend but announce dividend on cumulative preferred shares as a liability, because preference dividend in areas are not a liability until the board of directors authorize payment. The next topic will be presented by Farrel.
Okay, thank you, Jerry. I will continue. The type of current liabilities is customer deposit and advance. Short-term liabilities may include returnable cash deposit received from customer and employees. Companies may accept deposit from customer to guarantee the performance of contract or services or as collateral to cover payment of expected future obligation. For example, companies like Altel Corp USA often require deposit on equipment that customers use to reconnect to the internet or access other services. Altel may also accept deposit from customer as collateral for possible asset damage. The next is prepaid income. Magazine publishers such as Hachette FRA receive payment when a subscriber subscribes to its magazine. Airline companies such as China Southern Airlines or CHN sells tickets to future flight. In addition, software companies such as Microsoft in USA issue coupons that allow customers to upgrade to the next version of their software. How do these companies record the unearned revenue they receive before shipping goods or rendering services? The first is after receiving advance, debit to cash and credit to short-term liabilities account to identify the source of unearned revenue. The second is after obtaining revenue. Debit to the income account are received in advance and a credit to the earned income account. The next is the illustrate. To illustrate the logo, university is selling 10,000 football season tickets for $50 each for a 5-game schedule. Logo University recorded the ticket sales as follow in August 6. Cash is 5,000 rupiah, and the football ticket revenue received in advance is 5,000 rupiah. Is the record to the sale of 10,000 tickets. After each game, Logo University makes the following journal entry on 7 September. Football ticket revenue received in advance is 100,000 and football ticket revenue is 100,000. Is it to record the football ticket revenue earned? Unearned football ticket revenue is unearned revenue. So Logo University report it as a short-term liability in the statement of financial position. When revenue is earned, there's a shift from unearned income to earned income. The next is sales tax payable. Retailers such as Walmart in USA, Carrefour in French, and Tesco in GBR must collect sales tax or value-added tax or VAT from customer on the transfer of tangible personal asset and for certain services and must then remit this tax to the authorities appropriate government. Many companies do not separate sales tax and sales amount at the time of sale. Instead, the company credits the total amount in the sales account. Then, to properly reflect the actual sales amount and sales tax liability, the company will debit the sales account for the sales tax amount on those sales and will credit the sales tax payable account for the same amount. And the next is the example, like the entry below illustrates using the sales tax payable account on a sale of $3,000 when applicable sales tax rate is 4%. The journal is like cash and account receivable 3,120, sell 3,000, sales tax payable and is 120. Many companies do not separate sales tax and sales amount at the time of sale. Instead, the company credits of the total amount in the sales account. Then the properly reflects the actual sale amount and sales tax liability. The company will debit the sale account for the sales tax amount on those sales and will credit the sales tax payable account for the same amount. And for the next slide will be explained by Farhan.
Okay, thank you, Farrel. And the next is income tax debt. Most income tax vary according to the amount of annual profit. Using the best available information and judgment, business should prepare income tax filing and calculate income tax payable occurring from operation in the current period. Companies must classify tax payables in net income as current liabilities, which are calculated on the tax return. Unlike corporations, so proprietorship and partnership are not taxable entities because individual proprietorship and partnership members are subject to personal income tax on their share of the taxable income of their business. Income tax liabilities are not included in the financial statement of privately owned and partnership companies. And the next is bank loans and other debts. Loan to banks can be in the form of investment loans, working capital, or other loans. As with other debt, bank loans are listed at the nominal value of the remaining outstanding debt. Interest on outstanding debt is recorded separately in the estimated interest payable. Likewise, with the obligation to withhold tax. And the next is types of long-term debt. The first is mortgage debt. Debt that arise are related to the acquisition of funds from loans that are collateralized by fixed asset. The agreements that the borrower's asset are used as collateral in the form of land or building. The borrowers doesn't repay on time. The lender can sell the collateral which is then calculated against the debt. And the next is bond debt. The first is if the company requires additional working capital but cannot issue new shares, it can be met by seeking long-term debt. And the next, if it is difficult to find large amount of the debt from one source, the company can issue bonds. This bond can be sold if the company reputation is good enough and it is deemed that it will remain standing for the period of issuance of the bonds. And the next, the selling price of the bonds depends on the interest rate of the bonds. The higher the interest rate, the higher the selling price of the bonds and vice versa. The lower the interest rate on the bonds, the lower the selling price will be. And the next, liabilities. Liabilities can also be viewed from the point of view of value, namely, the amount is fixed or the amount is an estimate. Example, account payable and not payable. The status of the liability is certain, but the certainty that gives rise to the liability is highly depend on the future events. Example, the company is sued in court to pay compensation, which is very depend on the court decision. And a statement of the financial position or balance sheet included in the liabilities include 1. Trade payables and other payables. 2. Financial liability. 3. Liabilities and asset for current tax, or see the definition of the current tax in PSAK 46. 4. Deferred tax liabilities and asset refer to PSAK 46. Liabilities include the disposal group are classified as held for sale in accordance with PSAK 58, revised 2009. Okay, that's all our presentation. Thank you for attention. Assalamualaikum warahmatullahi wabarakatuh.